All right, let's just get right into it. The reason you're losing money isn't because of the market. It's because you're losing to your own gut reactions. You see a little bit of green, and boom, you sell. You see a sea of red, and you just sit on it, hoping, praying it comes back. Today, we're gonna fix that.
Okay, so you open up your brokerage app, you're scrolling through, and you see one of your stocks is up 11%. You feel that little jolt, right? Your pulse quickens. That feels good.
And what's the very first thought that pops into your head? Ooh, better lock that in before it's gone. So you do. You hit that sell button. You take that small, safe little win right off the table.
But then you keep scrolling, and you see another one. It's deep in the red, down 21%. And that feeling is completely different, isn't it? It's like a pit in your stomach.
So what do you do this time? Nothing. You hold. You tell yourself, you know what? I'll just wait. I'll wait till it gets back to what I paid for it. You basically marry your losers, hoping they'll turn around someday.
Look, this pattern, it is costing you a fortune. So today, we are going to fix it for good with a pre-committed sell plan that you can literally copy, paste, and set up in 20 minutes. Let's do this.
First things first, you have to understand that the real enemy here, it isn't the market. It's not your stock picks, it's your own brain. We're actually fighting a really powerful psychological trap. And that trap has a name: loss aversion. It's a really simple idea, but it's so destructive. It just means that the pain of losing $100 is way more intense than the joy of gaining $100.
How much more intense are we talking? Well, the research has actually put a number on it, and it's about twice as powerful. The pain of a loss is double the pleasure of a gain.
And this 2 times number, it's absolutely critical, because it's the fuel for something called the disposition effect. That's just a fancy academic term for the exact mistake we're talking about: selling your winners way too early and holding on to your losers forever. That feeling is what's driving all your bad decisions.
So how in the world do we fight back against our own brain? Well, we start by dragging this unconscious enemy out into the open. You've got to name it, and then you have to measure its impact.
Does this sound familiar? This is the voice in your head. On a good day, it's screaming, better lock in these gains because you're afraid of losing them. And on a bad day, it whispers, just hold until it gets back because the pain of actually selling for a loss is too much. See? It's a perfect trap. To break this cycle, you need cold, hard data. You need something objective. So from now on, you're going to track one single number from your brokerage account every quarter. It's called the Disposition Ratio. And the formula? It is so simple. Just look at the stocks you actually sold in the last 3 months. You count how many you sold for a profit, and you divide that by the number you sold for a loss. That is it. This one number will tell you everything you need to know about your emotional patterns. And this chart, this shows you what we're up against. The average investor has a ratio of 3.5. That means they are selling their winners 3.5 times more often than they're willing to cut a loser. That right there is the disposition effect on a chart. Our goal is to absolutely crush that number and get it down towards our target of 1.0, where we're making rational, balanced decisions.
Okay, so how do we actually get that ratio down? Simple. We use structure to defeat emotion. We're going to split our money into 2 different buckets, and each bucket is going to have its own set of non-negotiable rules.
So, think of your portfolio like this. Most of it, the big part, is what we'll call the baseline. This is your boring, stable, core stuff, like broad index funds. But then you have this smaller, separate slice. This is your tilt. This is where you put your single stocks, your sector bets, the stuff where emotion really tries to mess with you. And the rules for each bucket are totally different. For your baseline, you never sell based on a feeling. Ever. You only act if a fund gets way out of whack. Say it drifts plus or minus 20% from its target, and you only even check it once a quarter. But for that tilt bucket, you are not allowed to buy a single thing without having a written sell plan in place before you hit the buy button. Period. End of story. And now we get to the heart of it. This right here is the contract you make with your future emotional self. These are your new default settings for everything in that tilt bucket.
All right, rule number 1. This is your circuit breaker. If any stock in your tilt bucket drops 20% from what you paid, you sell. You're out. You exit the very next morning when the market opens. There's no debate. There's no second guessing. No, oh, maybe it'll come back. It's just gone. And rule number 2 is how you force yourself to actually let your winners do their thing. As long as your original reason for buying the stock is still true, you just hold on, and you protect those profits with a trailing stop loss. Think of it as an automatic sell order that only kicks in if the stock falls, say, 25% from its highest point. The only other reason you'd sell is if it gets so huge it's more than 10% of your entire portfolio. Then you're just trimming to manage risk, not because you're scared.
The best part? You can put this whole system on autopilot in like 20 minutes. First, set up automatic contributions to your baseline funds. Set it and forget it. Second, go into your app and create price alerts for those -20% and -25% triggers. Third, literally copy and paste your sell plan into the notes section for each stock you own. Let the system be the bad guy for you.
Okay, so let's walk through a quick example to see how this actually works in the real world. We're going to look at a hypothetical quarter and watch how the rules, not your feelings, make every single decision.
So here's our tilt portfolio. Stock A is a huge winner, up 46%. So we just set that trailing stop and let it run. Stock B is down a bit, but hey, it hasn't hit our rule, so we do nothing. But look at stock C. It just crossed the line, -21%. The rule triggers, we exit. No emotion, no debate, it's just done. And stock D, it's gotten so big it's a risk, so we trim it back. See? Every single action is mechanical.
And this right here is the most important part of this whole thing. The real victory this quarter isn't the profit or loss. The win is that you followed a better process. You cut your loser without thinking, and you let your winner run. And when you go to calculate your disposition ratio, it has dropped from 3.5 all the way down to 1.6. You are literally rewiring your brain. You're winning the game against yourself.
So the only question now is, what are you going to do? You have the plan right in front of you. Are you going to adopt these numbers, the 20% cut, the 25% trailing stop, exactly as they are? Or are you going to tweak them a little bit to fit your own personal strategy? Go down to the comments right now and tell me. Type adopt or tweak and let me know why. Go on, make that commitment.